Hi, I'm Mike Halveston with Whitford Financial Planning, and today we're going to discuss what comes next after you inherit an IRA. So, not all inherited assets are created equal, and there are particular rules regarding required withdrawals when it comes to IRAs. So, the first thing you need to determine is what type of beneficiary group you fall into. So, an IRA account would have a beneficiary name, and that's who the account passes to after the owner dies. So, the first group is eligible designated beneficiaries. Lots of terminology here. Then we're going to get to non eligible designated beneficiaries. And really, the difference here, the eligibility is there used to be a rule called a stretch IRA, where you could take an IRA that you inherit and make withdrawals over your remaining lifetime or stretching out the withdrawals. So essentially, if you're not eligible or non-eligible, that means you have a much shorter time frame to take the money out. So looking at the eligible designated beneficiary first, these include surviving spouses, beneficiaries that are not more than 10 years younger than the decedent, so maybe a sibling, certain minors and disabled or chronically ill individuals. For these beneficiaries, the old rules from prior to the 2020 Secure Act still apply, and they're generally able to stretch distributions over their remaining life expectancy. However, only the spouse of a decedent can roll over an IRA into their own IRA. For all others, an inherited IRA must be created and kept separate from their other IRAs. So then we get to the non-eligible designated beneficiary, and this is probably the biggest group or the most common. These are all the other human beneficiaries named on an IRA account, most commonly the children, friends, or other family members. And this type of account must be emptied within 10 calendar years, starting with a year after death of the original owner. So much different than a life expectancy, which may be much more than 10 years for someone who inherits the account to have to take it out over 10 years. And then thirdly, there's non-designated beneficiaries. So these generally include entities, estates, charitable organizations, and trusts, non-people, that are listed as beneficiaries. And this group typically must empty the account within 5 calendar years, starting with a year after death of the original owner. So there's 3 groups, and then there's the calculation of the correct distribution amount. So in order to calculate required distributions, 2 pieces of information will be needed. You need the prior year ending account value. So for example, for 2023's required withdrawal, we would use the December 31st, 2022 account value. And then the life expectancy, which comes from a table. Again, it's going to be a life expectancy for many years, or potentially the 10-year period or the 5-year period. Once you get that factor, which is based on your age in the year after the IRA owner's death, then you would divide it by the account balance. For people who are inheriting an IRA that fall into the non-eligible beneficiaries, this calculation only needs to be done once, and then the following year you would just subtract 1 from the prior year's table factor. Now, there's other important considerations here. All these dollars coming out of an IRA, if they're a traditional IRA, are most likely going to be taxable. So if you inherit a $1 million IRA from one of your parents, you've got 10 years to realize $1 million of income on your tax return, assuming it's all pre-tax money inside of that account. So you could take minimum distributions, you could take 1/10 out per year, or you could wait till the end of it. But essentially, there's a huge opportunity here for tax planning. So these are going to be withdrawals that are added to your income for the year that you take them. So if your parent passes in 2022 and you take your first RMD in 2023, then it'll count as income in 2023. So maybe you want to consider taking the money out during low income years to minimize the taxes because it'd be stacked on top of your regular income, or maybe spending from this IRA if you want to accelerate and take the withdrawals faster than, say, 1/10, this may allow something like a pension or Social Security to grow to be a larger amount. So maybe you would use that money to live on earlier in the 10-year period. Some other considerations include Roth IRAs. So Roth IRA owners don't need to take RMDs during their lifetimes, but beneficiaries who inherit Roth IRAs do have to take RMDs. If you're inheriting a Roth, though, your RMD would be calculated in a similar method as before, but generally, Roth IRA distributions are not taxable, no matter who ends up taking the distribution. So obviously, with inheriting IRAs, there's a lot to consider. You can visit our website at whitfordfp.com to learn more, and we'd be happy to help.